In this video, we're going to take a look at a brand new dividend ETF that just launched about 2 months ago. This fund has some pretty interesting features, and I've gotten a handful of requests to give an analysis on it. The ETF we'll be looking at today is called the Roundhill N100 0DTE Covered Call Strategy ETF, ticker QDTE. According to their website, QDTE utilizes a synthetic covered call strategy that seeks to provide current income on a weekly basis, while also providing exposure to the share price returns of the Nasdaq 100 index. This ETF is the first ETF to utilize 0 days to expiry options on the Nasdaq 100. QDTE seeks to provide overnight exposure to the Nasdaq 100 and generate income each morning by selling out of the market 0DTE calls on the index. With a dividend yield of over 30% and weekly dividend distributions, not monthly, there's obviously been a lot of interest from people in this ETF who love income investments. The company offering this ETF is called Roundhill, and I've known about them for a little bit, but I wasn't aware that they were offering synthetic covered call ETFs or weekly paying ETFs. In the past, I have covered a couple ETFs that were known for paying weekly dividends. The company SoFi launched 2 ETFs a couple years ago, which were WKLY and TGIF. Both ETFs paid a consistent dividend every Friday, but SoFi liquidated both of these funds a while ago, and today they no longer exist. But despite both of these ETFs offering pretty low yields of around 2 to 3%, they were actually pretty decent investments. I think they failed simply because the demand wasn't there to get paid weekly, plus you could earn almost twice as much money from a high-yielding savings account in our current environment. Roundhill also offers another ETF that's very similar to this one in that it uses the same option strategy and it also pays weekly. That one is the Roundhill S&P 500 0DTE Covered Call Strategy ETF, ticker XDTE. This fund does what QDTE does, only this one is for the S&P 500. This fund company in general has some pretty unique ETFs that have strategies that you don't normally see from other fund managers. They have ETFs like MAGX, which uses leverage to 2x all returns from the 7 biggest companies in the Nasdaq. They also have YBTC, which uses a synthetic covered call strategy on Bitcoin. As I hope you've realized at this point, all of these options-based ETFs do come with a much higher amount of risk. But in the case of QDTE, this one isn't like your average covered call ETF. It's not even like other synthetic covered call funds, such as what YieldMax offers. The reason they're called synthetic is because they don't have actual exposure to the underlying security. Regular covered call funds will buy the underlying security, whereas funds like QDTE will simply try to replicate it. The way they do this is by purchasing call options that are deep in the money. This refers to the fact that at the time the fund purchases these call options, the value of the Nasdaq 100 index is already well above the strike price of the options contract. This means the fund will exercise these contracts and will experience a gain equal to the difference between the strike price of the options contracts and the value of the index. It is a bit of a complicated strategy if you're more of a passive investor or if you don't really get into options trading. So I think it's worth comparing a synthetic covered call fund with a regular covered call fund from a share price perspective. Let's take QDTE and compare it with QYLD. Both funds use the same index, but QYLD is the traditional CC fund and QDTE is the synthetic fund. Over the last 5 days, both funds have performed about the same from a share price perspective. But you'll notice that the synthetic covered call fund has many more share price jumps than the ordinary covered call fund. QDTE has only been around for 2 months at this point, so we haven't yet seen a violent decline in share price for the index and what that might look like for this ETF. Now, to be fair, this fund is still a little thinly traded because it's still a brand new investment, but this kind of pattern is still very typical of a synthetic covered call fund. Speaking of which, QDTE is showing another symptom of these synthetic covered call funds that we've also been seeing with the YieldMax funds. The amount in dividends this ETF pays varies significantly from distribution to distribution. If we pull up a bar chart of QDTE's dividends, you'll notice right away that it varies significantly each week. In just 2 months, it's paid a dividend as low as 9 cents per share to about 37 cents. That's a 123% difference in income, which really took place over the course of just 2 weeks. If we compare this with QQQI, another Nasdaq 100 traditional covered call fund, over the last 4 months, its dividends have been much more steady. This results in the exact same issue that I raised earlier this week regarding these synthetic covered call ETFs. If your income is this unpredictable, it makes developing a budget around these kind of payouts extremely difficult, if not impossible. The goal of income investing should be to build up a reliable income stream that you can use to live off dividends in retirement or potentially much earlier. If you're loading up on these kinds of ETFs, it's almost impossible to construct a budget with this much variance in your income. With the more traditional covered call funds, their dividends aren't nearly as chaotic from each payment to the next. If we look at XDTE's dividend history, we can see a very similar pattern. It's even a little worse in this case, which is surprising because the S&P 500 isn't as volatile as the Nasdaq 100. It paid 2 cents on April 9th and then paid 37 cents on the 23rd, a 179% difference. However, this ETF does actually solve an issue that I've been pretty critical of for a long time with these synthetic covered call funds. As I've discussed in previous videos, we just haven't seen any of these kinds of ETFs offer a good amount of diversification. YieldMax, who paved the way for these synthetic covered call funds, used to only have exposure to just one company inside of each of their ETFs. But Roundhill is offering 2 synthetic ETFs that have exposure to a lot more companies. The Nasdaq 100 has 100 of the largest non-financial companies listed on the Nasdaq, and the S&P 500 contains 500 of the largest companies on US exchanges. The most diversified YieldMax fund, YMax, only holds 20 companies, and even the majority of these companies are all concentrated into just a couple of sectors. Over half of everything in YMax is technology related, and there's been a significant amount of hype surrounding most of these companies. So it's not even well diversified among sectors, and I'm concerned about what's going to happen in the event of a bubble. But QDTE and especially XDTE are exposed to a much larger amount of companies. You've got all the hyped up tech stocks, but you've also got energy, healthcare, industrials, real estate, and a whole host of other sectors. Diversification is one of the most important things investors need to do to keep their portfolio safe. With that in mind, these 2 ETFs I think are much more attractive than what YieldMax has offered so far, especially XDTE. I would expect the share price of these 2 investments to be steadier than anything YieldMax has launched. But the same issue remains regarding their payouts being too inconsistent. I don't believe that this is a holding anyone who's retired should depend on for their income. But I think an argument could be made here for owning either of these 2 ETFs if it's a very small part of someone's portfolio and they don't absolutely need to depend on the income from QDTE or XDTE, as in they have a whole host of other dividend-paying investments that provide steadier income. I'm still waiting to see how these 2 ETFs are going to perform after a major market sell-off happens. As we just saw, these synthetic funds tend to have a lot more dramatic share price changes. But in summary, I would consider these 2 ETFs to be the most promising synthetic covered call funds that I've probably come across. If they do pretty well, then I might consider actually investing a small amount into one of them. But when it comes to newer investments, I usually like to wait at least 6 months to see a consistent track record, but I have made a couple exceptions in the past. So that's my view on it. I actually do think they have somewhat decent potential, which honestly I'm not sure that I would ever say that about something yielding this high. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.